Welcome to the Challengers Podcast. I think we're going to be calling this the Banking Podcast from now on. I'm your co-host, Zack Miller, Tearsheet's editor-in-chief. Joining me is Josh Liggett. You want to introduce yourself, Josh?
What's going on, Zach? Josh Liggett from OurCrowd, principal on the investments team. And my tuxedo was in the cleaners for this episode. I apologize to all those
We'll take you as
watchers.
is.
Yeah, I'm sorry.
You're more the neobank and not the traditional bank, I see.
You gotta keep it light and breezy, as they say.
And we're here to talk about banking, all sorts. We want to explore sort of those topics and those companies that are making news and making moves in the industry. And so Josh and I have different perspectives, and we're here to chat about some of those important stories.
Yeah, man, let's do it. Startup side, Zack Miller side, Josh Liggett side, fourth side that we got to figure out. It's a lot of fun.
You're playing four-dimensional chess here. So
always.
Let's talk about Dave. So maybe taking a step back, Dave, neobank really kind of ramped very significantly in its early days, started as sort of a overdraft avoidance tool and moved into sort of square into challenger banking and ramped to millions of customers and then went public via SPAC, right?
That it did. It did go public in the SPAC craze of last year, which will be
right at the tail end, I guess, huh?
Yeah, right at the end.
Yeah. And so what's happened subsequently is, as a public entity, I guess Dave had its first earnings season. Things did not go so well.
Shocking. Shocking.
I love how Josh says it as it is. Yeah.
So go.
It's not, it's not specific to Dave. Like, we've seen this time and again with the SPACs that did get out into the public markets, that a lot of the projections, a lot of the hype behind these companies, once they hit public markets, sort of the gloss was taken off, huh?
Well, I think it's also what's happened in probably from, the big pullback that's happened the last few months, everyone taking a step back. Before, the market would tolerate a private, a private company going public, not necessarily having that path to profitability or break even.
The old unit economics that you talk about.
Yeah, never. We never spoke about that ever. and sort of that was justified because of growth. Mm-hmm. But now that's not justified anymore. They want to see that path. And we've seen that with some, great fintech product companies. Now, obviously, like you and I have spoken about Dave in the past and a lot of these other ones, these are great products. Like, these are really good products. They're great. They're awesome.
With users.
People with tons of users, people love them. But then when you get to like earnings season, and now you got to talk about the numbers and talk about revenue growth and user growth and increasing increasing burn, negative net operating income, it leads to shareholders not necessarily acting in the happiest manner, so to speak, to put it lightly.
So I think what happens here, and I saw some of the numbers, unfortunately I don't have them necessarily in front of me, but I think there's also, given where Dave placed itself as sort of a protector of overdraft fees, compared to some of the other neobanks or traditional banks, also it's not as sticky. It's not the type of thing you need to go and keep checking and hitting multiple times throughout the month. So I think some of their usability numbers were a little bit lower. And then so what happened was Dave went public. Growth wasn't what people expected. And then in forward guidance, I think Dave significantly ratcheted down what next year's revenues were going to be. I think I saw by $160 million or something, which is all the revenue that the company did last year. It was reduced by that amount this year. So as you're saying, like, unit economics, they come into the public light, right? And they do matter at a certain point. And so let me ask you this. So is this just a matter of Dave now, they've got the users, it is a good product, as you said. Is it just a matter now of layering on more profitable things like lending?
Well, you can go one of two ways. If you look at Dave, right, like what do they don't charge anything for overdraft. So they're losing money on that, period, because they're doing it off their, I don't know exactly how they're doing it. Either they're doing it off their own balance sheet or they're doing it off of, a line from a bank they're paying interest on that, right?
Mm-hmm.
Then you have, or they're just sitting on the cash flow and have to figure out when to get it back, right? Which is okay, but if they can do it off their balance sheet, that's great. But you need all the capital, and then if deal with defaults and all that stuff, one or the other. The problem is they're charging like $4 for that, for
A
zero.
month.
Yeah.
Yeah.
I think it like basically a month, because it's like per, every time that you send it. Do you want it now, or do you want it in like 2 days? If you want now, it's this price, and if it's 2 days, you want this price. So like, yeah, people really like it because you're basically giving them something for free for like $1.
Mm-hmm.
Of course I want it, and then shockingly, you're losing money on it. So either they have to, and this
scale massively, like hundreds of millions of users.
I don't even know. Even that may not be the issue. You could sort of do like what, I saw a TikTok about this, about freelancers, where a freelancer says, I'm busy all the time. And they say, double your fees, you'll be half as busy, but make the same amount of money. So either they have to up the fees, they'll churn out.
Work week,
they will, yeah, exactly. They'll have to up the fees, and they will churn like crazy, out of control churn. And that will be so ugly short term, looking that. And, people may freak out over the user growth will your cohorts will look ugly over the period of time. You'll have really bad churn. Or, but they'll be making more money and hopefully getting to better unit economics, or they have to upsell in other areas and add in more tools. Now, then the question is, now you're doing more marketing, product development. Are the investors going to be willing to sit with the time that it takes to add in another product? Are they going to have to buy a company? It's
does the brand extend into that, right? So Dave has a certain brand value. Like, does moving into short-term consumer loans make sense? I don't know.
And then are they going to charge zero for short-term consumer loans as well? Like,
right.
if you're trying to stay consistent with the approach of giving capital for basically as cheap as possible, how are you going to do that? Like you said, on the branding side. So they're not in a horrible position. They're still worth a couple billion, which is still nice. To be worth a couple $1 billion, and they still have a lot of users. The revenue growth was not where it has to be. I think it was like 16% year over year, which isn't great. And their burn was higher. But they're gonna have to figure this out. And I imagine they're gonna have to start charging more. I can't see a world where they don't. It's hard to imagine not charging more.
So I guess that second option that you gave, which was, adding new products or buying companies or whatever, like that's what MoneyLion did when they hit public markets. They immediately bought 2 companies. One was a creative agency, and one was even financial, embedded products marketplace. And very smartly, a similar story, I guess, of a sort of plain vanilla good product, with probably low monetization metrics, but building something with a lot of users and has a brand and can now extend into other places. And so you see MoneyLion did that with buying other companies to establish themselves. So it'll be interesting. Like, do you think Dave gets into something like BNPL or something?
I mean, why not? Again, it goes down to,
wait, is this something a colored card could fix?
Only green titanium green from Mars with an NFT could fix it. Obviously, Zach, they don't need more users. Cards are users. I'm sorry. Cards are the driving force of a business. I apologize. Of a challenger bank. That is card color adoption. You brought it up, not me. But I mean, are they
color adoption index? I like how you just
with CC.
We don't talk about that anymore. That's what's wrong in this market. We don't talk about cards. We're not launching the same frequency of cards.
Because now they're all digital BNPL cards that you don't need a card anymore. Now we need an NFT of my digital card. Then it'll be that it changes color depending on my mood. I think there was one that changed the color,
mood card
or something like that. Oh my gosh.
Well,
yeah, you go.
Well, so that's an interesting thing. BNPL, I guess everybody's kind of coming at the same thing from different directions, right? So BNPL, I just spoke to the head of risk at Affirm, have a podcast coming out today. Affirm doesn't see itself as a BNPL company. It's a consumer finance company. And so BNPL was just one leg into it. But there's a buy now function, which whenever I saw that announced, I thought Josh Liggett would find that hilarious. They don't have a like buy now, pay later. They actually have a buy now function, which is like they launched that product, which is funny because it's just a buy now button. But they want to be, when a consumer goes shopping, they want to be the card, they want to be the bank, they want to be the financial institution that supports those rails. From payments to returns to logistics to all that kind of stuff. That's what you see most of the BNPL companies moving into. And so they're now sort of, at least in the consumer's mind, the sort of home bank, primary bank, and they have a built-in revenue model. They make money as they do this. So is it just a better model to start with that?
I mean, maybe at the same time, we have to. I haven't dive deep in the Affirm unit economics and revenues. I mean, they're still burning cash. It's not like they're a profitable company, but you could argue that it's what BNPL is with the companies that are running these programs is pretty similar to what an issuing bank does.
Mm-hmm.
I mean, in many senses, and issuing banks can become incredibly profitable. So, it's sort of, how do you skin a cat? How are you going after it? So now could it be that BNPL is replacing challenger banks and then challenger banks are going after BNPL? Like, I mean, could we do that? Sure, we could absolutely do that. Like it can go into that direction because people either searching for users or searching for revenues. It's like, pretty simple. And then I think something that we've spoken about many times, and I know something you've been an advocate about for many years, is the idea of people banking with brands that they appreciate and that they like and they like working with, and that's been spoken obviously about embedded finance. What brand isn't going to be every brand offering financial services, but the reality is that you could brand, just like most people don't leave their first bank. It could be that most people don't leave their first challenger bank fintech that they actually like and use, not like uses like, hey, I got this thing on the side that I throw cash in every once in a while just to like do whatever. It would be interesting to see, in 5 years from now, 10 years from now, where the next generation of Robinhood comes out, when all the people who got super into Robinhood, because of the great UX and because of how easy it is and because of all the hype that went around, with, the past couple of years, are they just going to, even if it's a superior product, that it's cheaper or better UX or whatever, are they just going to stay on Robinhood because I like Robinhood and
or
that's
just
my go-to?
Takes too much energy or effort to switch, right?
Which
There's
is
some
what
fatigue. I feel like there's fatigue in the market, there's so many options now. Like, I'm going to move again and again and again.
But it's also, I think I remember seeing a statistic that like the first bank account you open, you just like it's rare that people close that bank account.
Yeah.
Unless you move, unless you like go to a different country, you're just going to keep it because, yeah, I have that bank account. Cool. So could it be like that with fintech brands that you actually use as your primary financial tool? Not like, I have 7 challenger banking apps on my phone and I don't use any of them because like I felt like it, but like the one I actually interact with. And it could be that with a company like Dave or a company like Affirm, where people really enjoy the product, they like the UX, they like, the CEO, they like the community around it, sort of like community banking, quote unquote. It could be they stick with that for a long time, and then as they add more products, they just upsell them, over time. I think that's a very strong possibility.
The rebundling, right? It was the unbundling, and now
Absolutely.
You've built a brand, and you get your initial few million users, and now you just start to layer more things in, and
absolutely,
it's sort of like it feels a little depressing, right? Because like you sort of want to be like it to be a meritocracy, like the best products win, but yeah, maybe the initial best products do win, but then it's just a matter of scaling a business, which is hard. It's just hard. It's hard for any business to do.
I've been in tech way too long to know that to believe that the best tech wins. It's all it's product. A lot of times the best product wins, or it's the first one to market. In many instances that just people like, and then everyone copies that UX. I mean, I was looking at when I was chatting with somebody about Discord. I'm like, have you looked at Discord? It's Slack. It's like it's like the same. Like the UX is like, this looks exactly like Slack, and just so because people got uncomfortable with this weird dashboard that Slack came out with, and that got market adoption, and now people like it now, and so You're going to have that with whether you want to talk to a behavioralist, or a somebody who's going to chat about product design and addiction or whatever, all that fun stuff that you want to talk about. But like
habit building, Josh.
Habit building. With that, is that the right term for it as opposed to the addiction? Habit building. That's like
behavioral triggers.
Yeah, it's like you find a UX that works, and then everyone just copies that with different functions, and like someone may come out with something that's more novel or more interesting theoretically, but if the masses are just used to something, then it's hard to change it.
It's a funny story. It has nothing to do with anything, but MetaBank, which is a bank that's acquired a few different assets, acts as a partner bank, has some payments assets, and anyway, it just rebranded today. But the fact that they choose the word, the term MetaBank, people thought Meta, which is Facebook, this was like the metaverse bank for Meta, and actually they saw business from this over the past while. This wasn't the story was about it rebranding, and then Facebook ended up buying their brand assets.
Yeah,
we're gonna do something with that. I just thought that was a very interesting, funny story.
That's like when Zoom
being in the right place.
When Zoom went public, and the other Zoom stock went through the roof because people thought that was
payments.
Zoom.
Yeah, exactly.
Yeah,
exactly.
Yeah.
I know you were at a conference today. I know Rebecca, who's the head of our studio, said she heard you speak. Maybe tell the listeners and watchers a little bit about what that conference was about, what you spoke about.
Yeah, so I moderated a panel at Tel Aviv FinTech Week about DeFi. The title was Banks versus Blockchain. And we had one person from a bank in Israel, one person from a bank in the UAE, and then 3 startups, one working in wallet, one working in custodian, one working in creating smart contracts and stuff like that. And so we had a lot of different perspectives. And so, a lot of interesting things came out of it. The first thing was that everyone agreed that it's not DeFi versus banks, it's banks and DeFi. Like they all agreed, that this is something that's interesting. I asked them about what was missing from the market, what was missing, why there isn't mainstream adoption for DeFi yet. And, what the banker said, obviously 3 magic letters of KYC, which is, and the other 3 of AML, which is why a lot of banks, are hesitant to touch blockchain assets or DeFi assets, because of that cloudy nature, so to speak, of where everything came from. An interesting one that was brought up was about education UX, getting people to understand and get it better. And what came out that was really funny is that the conference was on a Tuesday in Tel Aviv, in the basement of not the basement, but downstairs at the Tel Aviv Stock Exchange, with a couple hundred people there, who 10 in the morning at a panel about DeFi. So we're talking you had to make an effort to get there and sit in the panel, and there were people outside mingling. These people wanted to see this, and I, before we started the panel, I told all the regulators to close their eyes and ears and ask the crowd, about 150, 200 people in the crowd, how many people here have used staking or liquidity pools or decentralized exchanges, or whatever. How many of you in the crowd have actually participated in that? My analyst who was in the crowd was there, and I knew he has, so I knew I was going to at least one.
You had at least one.
Yeah, I knew I got one.
You had somebody planted.
I had a plan. I planted it, and I pointed. I was like, I know you have to raise your hand. And 4 people raised their hands.
Wow.
And that just shows that at a conference like this, where this should be the whole room.
These are people building the stuff. Yeah,
these are people interested. Forgetting that they're probably part of the 1% that actually understands what a liquidity pool is, which 99% of people have no idea what that is, and everything around, DeFi, most people don't understand it. They can't use it. I mean, they're not using it either because they're hesitant, or because, it's hard to use, or because they just don't understand it 100%. They get freaked out when an exchange says they're offering 7% APR on an asset. They don't know what to do. This has to be a Ponzi scheme or something fake, And so that was the interesting comment. And then at the end, I said we spoke about emerging markets. Is DeFi going to, get in front of banks in emerging markets, traditional finance in emerging markets, which there were, mixed feelings back and forth. And then the last thing we obviously had to talk about NFTs, and everybody, including the banker, was very positive about NFTs in the long run. And that's saying NFTs where they are right now is, just like, I think one person pointed out that the first app on an iPhone was like a fart button, and the thing where you like turn your thing and turn your phone and it makes it look like you're drinking a beer.
Yeah.
Like those were the first apps.
Or a leveler.
Leveler. I still use my phone as a leveler. It's great. So like those were the first apps for like these like things that were like, I don't
People
really
just
know.
playing around.
Yeah. So that's sort of where they see, where everyone was talking about NFTs in terms of, actual assets, real estate, bill of lading, securities, all the nonsense. Saying NFTs
mortgages,
are everything. Pick an asset and turn it, tokenize it, and do all sorts of crazy things with it, and can go a lot further than traditional assets. And that was something that I was very happy that people on the same page on, especially having a banker talk about like, I love NFTs. I think they're great. So that was it was a lot of fun. We laughed a lot. We made sure everyone was happy, cleared everything with the lawyers afterwards, and make sure there were no comments that would get anybody in trouble. But no, it was a lot of fun. It was a good panel.
That's awesome. I'm sorry I missed it. Apropos that, though, I just want to say to our audience out there that Tearsheet is hosting something we're calling Bank Chain, which is blockchain and banking put together, a term that we made up. It's our first inaugural conference in the space. It's in May. It's a full day online. We have some complimentary tickets up on the website. If you head to the website, all the top firms in DeFi that are creating products and services that work with traditional finance will be there talking about how this all takes place and some of the early use cases and maybe where they think it's headed in the future. So I definitely encourage our listeners to check that out. I think we're nearing the end of our conversation today. Josh, was there anything else you wanted to share?
I think there was one thing I wanted to chat about, which was Apple made a little tiny,
with the credit kudos acquisition.
Tiny, I mean, the question is when Apple pays $100 million for a company, do they need to get a full approval, or can they just write the check on the spot? Like in the meeting at the Starbucks,
It's like in the marketing budget. Yeah. So they brought, I think you're referring to the Credit Kudos acquisition. So I know on Forbes, Ron Shevlin from Cornerstone said, basically the way people are thinking about this story. So Credit Kudos is sort of an open finance data platform. Most stories, I guess, that followed were talking about why Apple would be doing. That's the question. So like the acquisition was so small, but the real interesting part of this is when you think about, well, where's Apple headed? So he said there were basically four things that people were saying. That one is that Apple is going to launch their card in the UK, but that's unlikely because Goldman Sachs backed the first one and they already have a foothold in the UK. And why would you need this? Another one was offer buy now, pay later, apropos what we had said previously. Also, he didn't think that was necessarily true. Enable account-to-account A2A payment via Apple Pay. And the fourth was a tech or talent grab. He ultimately said that he didn't think it was any of those four things, but that it was either building out a digital e-commerce system like Square and Klarna have, or improving its data management analytics capability. Those seem more likely than the first four. Do you have a dog in the fight, or?
Do I have a dog? I mean, as long as the Apple Card is pretty, that's all I care about. But it's surprising. It was surprising to me because, like you said, they've partnered in the past with when the Apple Card first came out, we were really excited. Apple's sitting on God knows how much cash.
Yep.
Would Apple actually go out and underwrite their own credit card? That would that would be like such a crazy happening. And then we find out that, okay, it's traditional credit rails. Goldman's backing it, and Apple front end. They're basically just like, that's fine. Like, but it wasn't that we joked around on Twitter how people were talking about how monumental this is. It wasn't that monumental, but it just showed Apple getting into the market. So doing this, I like you said, I'd be surprised if they went to try to build their own credit card straight up, because in the past they've partnered rather than built themselves in this space, and while doing things like this. But what's interesting, and I think what's overlooked sometimes, is sometimes
just like an infrastructure play. It's in the guts, right?
Yeah,
It's a little more
exactly.
different.
Yeah, exactly. And like licenses and all that stuff, those plays can come out and yield results down the road, and they can be small acquisitions. I mean, we were chatting about Final getting Goldman acquiring Final, I think back in 2018, which was some people have said that's sort of part of their credit card packaging, and sort of the guts behind it. That it came from that, which it was a acquisition that they didn't even release. It was basically an acqui-hire, so I don't think it was a number they didn't release how much it was for, so it must not have been that meaningful. And then you had another one which didn't go through, which was when Ant tried to buy MoneyGram, basically for the licenses and the infrastructure, which was obviously a much bigger check, and it was a huge acquisition, and it was in the billions. But they didn't really care about the business; they cared more about the infrastructure, like you said. That was the play. So, is there an infrastructure play around this? Perhaps, or maybe it's a talent grab. I don't know, but I don't sleep on big tech companies or big, financial players coming in with these small acquisitions that sometimes fly under the radar, that end up being like a big part of a long-term strategy that doesn't come to fruition for like 3 years.
Yeah, it's interesting you said that, because I think Ron Shevlin in his article says that Apple's sort of renowned for that. Well, they'll make this this is typically a good size acquisition. Like Apple typically buys companies in this size. And then you don't really see what Apple's was thinking about or what they were doing with it until 2 or 3 years later, exactly like you said. So it's something to talk about. I think you're right. We were looking for something monumental, something transformative with the Apple Card. It wasn't. I'm sure it's a good business. I haven't looked at the numbers recently. I'm sure it's a good business for Apple, and has lots of ecosystem, value to what Apple is doing. But it wasn't the transformative product that we were maybe hoping it would be.
Yeah, I mean, it was a great, listen, not to revamp on it, but it's a great idea. It's reinforcing, the Apple Pay function and the,
Apple Cash staying in the
Apple
system.
Cash and the fight with the different wallets, which we spoke about years ago when Walmart, they tried to put that consortium together.
Yeah.
Except Walmart, left, the whole, putting the consortium together to fight the Google wallet and the Android wallet, the Apple wallet. It's something that makes sense. It's a reinforcing move to try to, simple, clean, take them, go to market much quicker without the regulatory headache, but we sort of yearn for more, from sort of like the Steve Jobs days of this, crazy, ideas coming from Apple or
I think we look to big tech for that.
Yeah.
As those breakthrough products, and they haven't in finance yet. It just has never happened. Not Google, with the Google Plex, the Google bank accounts that we were expecting come out. I actually don't know how big a threat big tech is. I know everybody was afraid of it a few years ago about them moving in and taking a big market share, either way from banks or from fintechs, but it's not easy for them.
I think what's telling is when Facebook got in trouble for data privacy and then came out with Libra, and they flipped out over Libra. They went crazy.
Nobody was going to allow that product to market. Yeah.
Forget data privacy. You can steal all their data as you're not creating new money. It was that shows like and when people try to get involved in fintech and they're like first coming in, we have analysts or friends of mine come up and we talk about fintech, and the thing I say is like you have to realize it's a different beast regarding compliance, regulators, and just the market pushing back when you're an entrant trying to come in and fight with JP Morgan and fight with Citi and fight with the Fed and fight with all these different things. It's a different fight.
A grind. Yeah.
It's different. And so big tech is sort of, okay, maybe they've decided to go in different areas. Maybe they're working on different things. Now they're, going to work on the metaverses. You're my editor, so you tell me.
I haven't actually thought of that yet, so I like metaverse on that one.
Can we do metaverse I like that.
It feels like that's what it would be. Yeah.
Yeah. So in the different metaverse ISIS, whatever it is, having payments and just embedding, having fit, and this is sort of something that you spoke about years ago, which is fintech being the pipes to, and banks being the pipes around everything, just to enable transactions, enable finance, enable commerce. So that it could be that big tech sort of, hasn't really, because they haven't really jumped in as it hasn't been as transformative as we've wished. It could be that we have that step back and that compromise.
Yeah, Josh, I have to say it's always great talking shop with you.
Always great. We got to do this now. We're going to do this definitely more often, because we have to bring more discussions about colored cards into the world now that there's no now it's all BNPL and digital.
Josh Liggett, thanks for joining me on the Challengers podcast.
Zach, thanks for having me. Have a good day, everybody.